First up, what exactly is a 50-year mortgage? It is pretty much what it sounds like, a home loan that you pay back over half a century. That's 50 years of monthly payments, 600 payments in total. The traditional mortgage is usually 15 or 30 years, so this is a major extension of the timeline we're used to seeing. It's not a small shift. It fundamentally changes the long-term shape of your finances. The main appeal, and it's a big one, is a significantly lower monthly payment compared to a 30-year loan for the same house. With the same loan amount spread over a much longer period, your individual payments shrink. This can be incredibly tempting, especially for first-time buyers or anyone trying to break into a high-cost housing market. When home prices are sky-high and your income is still on the way up, those reduced monthly numbers can feel like a lifeline. Imagine being able to afford a larger home or a home in a better neighborhood simply because the monthly bill is more manageable. That bigger backyard, a better school district, a shorter commute. Things that felt just out of reach suddenly look a little closer. For some buyers, this lower payment could be the difference between renting for another 10 years and finally getting the keys to their own place. That emotional pull, the dream of ownership, can be powerful. It creates an illusion of affordability that can make the dream of homeownership seem within reach when it otherwise might not be. And for many, that illusion feels worth chasing. After all, if you're not buying now, how much longer do you wait? Prices rarely go down, and the fear of being permanently priced out is real. This is the good part of the 50-year mortgage. It offers immediate relief on your monthly budget. If you're just starting your career, or maybe you have other significant monthly expenses like student loans, childcare, or medical costs, the breathing room a lower mortgage payment provides can feel like a lifesaver. Instead of pouring most of your income into your mortgage, you could use the extra cash each month to build up your emergency fund, or invest it, or pay down high-interest debt, or just live a little more comfortably without counting every dollar. You might even take a vacation every now and then or finally replace that aging car without panic. The idea is that as your income grows over the years, you can handle the payments even more easily. Or perhaps refinance into a shorter-term loan down the road. Maybe after 5 to 10 years, you've advanced in your job, built up some equity, and are ready to switch to a 20-year or 30-year loan that pays off the rest more quickly. It's all about getting your foot in the door of the housing market now, rather than waiting and risking being left behind. Proponents argue it's a tool for accessibility, opening up homeownership to a wider group of people who are currently priced out. In markets like San Francisco or New York, where starter homes cost well over $500,000, options like this can feel like the only entry point. But as with anything that sounds too good to be true, there's always a catch. And that brings us to the bad side of the 50-year mortgage, the interest. This is where the numbers get really scary. While your monthly payment is lower, the total amount of interest you'll pay over the life of the loan is astronomical. We're not just talking a little more. We're talking about potentially paying 2 or even 3 times the original price of your home in interest alone. Why? Because with such a long timeline, interest has decades to stack up. You're giving it space to breathe, and it grows. Let's run a quick simplified example. Say you borrow $400,000. On a 30-year mortgage at 6% interest, you'd pay about $463,000 in total interest. That's already a lot more than the loan itself. But on a 50-year mortgage, even if the rate was the same, and it's often higher, you'd pay over $850,000 in interest. That's nearly $400,000 more out of your pocket, all going to the bank, not towards your home. And if your rate is higher, that number only climbs. Lenders may charge a premium for these longer-term loans because of the added risk. So even small bumps in the rate can drastically increase your final cost. The longer the loan term, the more time interest has to compound against you. You're essentially paying a massive premium for the convenience of that lower monthly payment. It's like renting your own home from the bank for decades. You're not owning, you're just prolonging the cost of buying. This staggering interest cost leads directly to the ugly part, your equity or the lack of it. Equity is the portion of your home that you actually own. It's the difference between your home's value and what you still owe on your mortgage. Building equity is one of the primary ways homeowners build wealth. It's how you move from being a borrower to an owner. With a traditional 30-year mortgage, you start building equity at a decent pace, especially after the first few years. At the start, most of your payment still goes toward interest. But over time, more of it shifts to paying down your principal. That shift is crucial. But with a 50-year mortgage, the process is painfully slow. For the first decade, or even two, the vast majority of your monthly payment is just going towards interest. You're barely making a dent in the principal loan amount. So what does this mean in the real world? It means if you need to sell your home within the first 10, 15, or even 20 years, you could be in serious trouble. You might find that you owe almost as much as you originally borrowed. It's like treading water financially. You're making payments, but you're not moving forward. If the housing market has been flat or has dipped even slightly, you could end up underwater, meaning you owe more than your house is worth. That limits your options. Selling might not even be possible without bringing money to the table. You could be stuck. This severely limits your financial flexibility. You can't just sell up and move for a new job, a growing family, or a life change without potentially having to bring a big check to the closing table just to pay off your lender. You're essentially tethered to the property and the bank for a very, very long time. That's not just inconvenient. It's dangerous, especially in a world where mobility matters. If a better opportunity comes along, different city, different lifestyle, you might have to turn it down because your mortgage won't let you go. This slow equity growth is a huge long-term wealth killer and is one of the biggest hidden costs of these ultra-long loans. So who could a 50-year mortgage possibly be for? The ideal candidate is very niche. It might be a young, first-time buyer in an extremely expensive market who has a very clear and reliable path to a significantly higher income in the near future. We're talking someone who's about to finish medical school or law school, or a tech professional on a strong upward career track. The strategy for them would be to use the 50-year loan to get into a house, and then refinance into a conventional 30-year or 15-year mortgage as soon as their income allows, maybe within 5 to 7 years. In this scenario, they treat the 50-year loan as a temporary, introductory tool, not a lifelong commitment. It's a stepping stone, not a permanent plan. But this is a risky gamble. It relies on a promotion, a career change, or some other financial windfall that is never guaranteed. And even if your income does go up, life doesn't always follow a clean trajectory. Unexpected expenses, job changes, or a shifting market could delay or derail your plan entirely. If that income boost doesn't materialize, you're stuck on a very long and expensive road. And the longer you wait to refinance, the more interest you've already paid, and the less you've gained from the supposed savings up front. For the vast majority of people, the trade-off just isn't worth it. The dream of a larger home enabled by lower payments can quickly turn into a nightmare of debt. You're committing to being in debt for your entire working life, and possibly into your retirement years. Imagine still making mortgage payments when you're 75 years old. That's the reality for someone who takes out one of these loans at age 25. Think about that. Still paying off your house as you're trying to live on a fixed income. Still locked into a payment schedule long after your earning power has peaked. It can completely derail your retirement planning and long-term financial security. Instead of building wealth through your home becomes a financial drain that primarily benefits the lender. The monthly savings are often an illusion, masking the enormous long-term cost and the severe lack of financial progress. Before you even consider a 50-year mortgage, it's crucial to look at all the alternatives. Can you save for a larger down payment to lower your monthly costs on a traditional loan? Can you buy a smaller, more affordable starter home to get on the property ladder and build equity faster? Are there government assistance programs for first-time buyers that you might qualify for? It's also vital to ask yourself if you're being realistic about what you can afford. Stretching your budget to the absolute limit just to get a bigger house is a recipe for financial stress. In conclusion, the 50-year mortgage is a financial product that comes with some serious warnings attached. While the lower monthly payment is an attractive headline, the devastating long-term interest costs and incredibly slow equity buildup make it a trap for most homebuyers. It can create a cycle of debt that lasts a lifetime and hinders your ability to build real wealth. It might seem like a lifeline in a tough housing market, but it could end up being an anchor that weighs you down for decades. Always weigh the short-term affordability against the long-term cost. Your future self will thank you for making a smart, informed decision today. What are your thoughts on this? Is the 50-year mortgage a creative solution or a dangerous gimmick? Let me know in the comments below. Thanks so much for watching, And if you found this helpful, be sure to hit that like button and subscribe for more content on making smart financial moves. See you in the next one.